What are accounting concepts and conventions? What role do they play in accounts? What is their purpose? Hi, my name is Rajesh Thakur, and in this video, with the help of an example, I'll explain you each and every aspects of these important accounting concepts and conventions. So let's start and understand that. Accounting concepts and conventions. What are accounting concepts? Accounting concepts are assumptions or rules based on which business financial transactions are recorded, whereas accounting conventions are the principles that is accepted by all the accounting bodies. These are developed over a period with experience, and it could be possible, like new circumstances comes, new changes has occur, and based on which if there could be a requirement to change the accounting principles. So that is possible in case of accounting principles or conventions, but accounting concepts, they are not changed. So what are the important accounting concepts? Let's understand. Let's say you wish, with the help of an example, let's say you started a business. Now you are incurring some transactions, or you incurred some expenses, like you bought a laptop for your daughter. Now, whether this transaction will you record in your business or not? The simple answer is not, because that is for your personal purpose. So in order to bifurcate the personal expenses from the business expenses, a concept has been created. These are the assumptions, because it has been assumed that business is separate from the owner. So business is been taken as a separate individual entity from the owner. So anything which is of the personal nature doesn't get mixed up with the business. So that is why this business entity concept has come up. And this is the reason why, if you look at any balance sheet of a company or a business, you will see the capital that has been introduced by the owner of the business has been shown towards the liability side. Why? Because business is a separate entity. Business has to pay back the capital, and over and above, over the period, the profit which has been earned by the business, all these capital and the profit, a business is required to return back to the owner. So that is why the capital has is used to shown towards the liability side of the business. So this is business entity concept. I mean, the business is separate from the owner. Now the things come, what transaction will you record in the business? So I said business financial transactions. So the transaction which can be measured in money terms, only those transactions will be recorded in the business, and that is called money measurement concept. Money measurement concept says all the transactions which can be recorded in money terms will be recorded in the business. Any transactions which cannot be valued in money terms, let's say effectiveness of workforce, or you can say quality of a manager, or you can say the training that has been imparted to the employees, all these has an impact on the business, but as they cannot be valued in money terms, they will not be recorded into the business. So with this also, this one thing comes, you have started your business. How do you see that? You want to close it down? No, you want to say that your business flourished, it reached new height, or you'll see it like, it could be like Infosys, Reliance, Tata. So for that purpose, what is the assumption? The assumption is that your business is going on. It's on a going concern concept, that you have no intention to close a business. Let's say you see your life, right? So in your life, in your home, you buy computer, you buy a laptop, or you buy AC, you buy a fridge, you buy a bed, you buy quilts. So there's so many assets which you create. Why? Because you know that this will be required over a period of time, and that's why you bought them. One question: if you want to celebrate your son's birthday or your daughter's birthday, do you buy the hotel or the center where you want to celebrate the birthday? No, you don't buy that. You take it on a rent basis. Why? Because you are not going to celebrate your birthday in the same hotel every year, right? So that is why all those things which are done or required for your life, and you will use them over a period of time, that you will buy them. and that asset will provide you benefit over a period of time. So the same way, all the business transactions is recorded with the assumption that your business will go on, it will reach new heights, you will make profit, and all other stuff. So all the transactions in business is recorded on the assumption that you are going on with this business. You have no intention to sell it out. Let's say that I'll give you an example. Let's say you bought a land for your business. Land, once you have recorded, let's say 10 years back, that has let's say 1 lakh value. But after 10 years, its value will definitely increase. But in the business, you don't record it as a current value of the land. Why? Because you don't have intention to sell your business. You are not recorded it on what value it is having now. So that is the concept, that why this has been recorded based on when you had bought it, because you want to use it over a period of time, because you want your business to go on and go on. So that is why this going concern concept has been taken up. Now you started your business, you are incurring so many transactions, but how do you compute your profit? So to compute your profit, you have to stop at one point of time, right? Let's say if you keep on recording transaction year after year, but you will not able to get how much profit you have earned. Why? So one point of time or one period of time, you have to close all the transactions of a business and then compute your profit, and other assets and liability you will carry forward or move forward. You close those accounts and then you move it forward for the next year. So that's why this periodicity concept has introduced, that over a period, let's say a financial year or quarter, you close your books of accounts and record what is your profit and what's the assets and liability at that point of time. So this is how the periodicity concept has come up. One important concept that is there, it's known as matching concept. It's always that you are incurring some expenses and you are you earn some revenue. So what is this? The matching concept says, if you shown a revenue, the related expenses to earn that revenue you need to show in your books of accounts. So matching concept says, if you have revenue, so the expense related to this revenue you'll have to record in your business. So this is matching. And based on this, the other concept which has emerged, that is accrual concept. Accrual concept says that irrespective of whether you make the payment or not, whatever amount you have incurred or whatever amount from the sale of goods, the revenue which you have generated, irrespective of whether you have received the money or not, or in case of expense, whether you have paid the money or not, you have to record those transactions into the business if it relates to that particular period, like I said in the matching concept. So accrual concept says anything which you have earned or the expense you have made, for which irrespective of whether you have made the payment or not, you will record those transactions into the books of account. So these are important accounting concepts based on which we record all the business financial transactions. Now what are accounting conventions? Accounting conventions are methods or procedure or common accounting practices which has been accepted widely by accounting bodies. All these helps in preparation of financial statement. And why do we require common accounting practices that we can go with when we'll analyze different accounting conventions? So let's see what are the different accounting conventions. Convention is consistency. Consistency says that if you have followed a method, the same method you need to follow the next year or the year after. Why? Because unless and until you follow the same method, you cannot compare the two accounting period financials, right? Or for that purpose, let's say I'll give an example. What is this consistency refers to? There's a ways to value your inventory, like FIFO, LIFO, weighted average method, and same way a fixed assets can be depreciated by different method, like straight line method, diminishing balance, or return on value method. But this consistency says that you have to follow. If you have adopted LIFO method, so you will follow LIFO method year after year, unless and until there's the circumstances that if you change your method for that purpose, you can change that, but it should provide a better presentation of your financial statement. It adds more value to the investors or more value to the stakeholders of the financial statement. This consistency also comes with the disclosure. Disclosure says that any material transactions is required to be shown in the financial statement. Any material transaction. So what is material? Material is a concept which changes based on business to business. Let's say a business earns rupee 1 crore and it has an expense of about rupees 5 lakh. This is a material transaction for a business of who is having a turnover of 1 crore. But the same 5 lakh rupees transaction will not have a materiality if the total turnover of a business is 50,000 crore or 60,000 crore. So material transactions is all material transactions you need to show, disclose in the financial statement. Now come the materiality. Like we have said, the all material transaction we need to show. Materiality also says that the transaction which is not of a material nature, that is not required to be shown. Let's say I give an example. A company buy a calculator, right? Calculator has a life. It doesn't have a life more than a year, right? But we do not record these transactions as an asset because it says you need to evaluate, you need to see the cost benefit analysis of recording. If it's not material, so you can record it as an expense straight away. You will not record it because there's so many calculators, there's so much you accounts you need to maintain, and based on that you will compute, but that doesn't provide any value, any benefit to the investor or to other stakeholders of the financial statement. So all the like calculator you have bought, so all these been booked not as a non-current asset, but it has been booked as an expense. That much. Same way there could be some many expenses, like you bought bulbs for in your business, you bought flower pot in your business, or there's so many tiny things you buy it out which has a life more than a year, but all these are recorded not as an individual accounts for each and every bulb or flower pot or other stuff which you buy, but they has been put it under one bucket or as a general expenses, or you can say as a office expenses. So they are not bifurcated in that. So
material concept says that only those transactions or items will be disclosed in the financial statement which has significant economic effect, or we can say the transactions or the items which may influence or impact the decisions of the stakeholders of the business or stakeholders of the financial statement, then all those items needs to be disclosed in the financial statement.
Conservatism convention said that we should not anticipate any income and gains, but we need to provide for all the expenses or losses. It means that if till the date of finalizing the balance sheet, if we got to know about any of the expenses that's going to materialize, any contingent liability that's going to materialize, and we have to pay for that, so we need to account for those expenses into the business, but we will not anticipate any or estimate any income or gains which going to be in the future. So it says that you need to be little conservative approach that will book the expense or losses, but will not anticipate any income and gains. I hope now you are clear about accounting concepts and conventions, but still if anything is not clear, you have some doubts, please do write and I'll resolve your issues and query. Thank you, bye bye, take care, God bless you.